Hello, welcome back to a new video, and in this video we're going to talk about how to combine the best indicators to find the perfect trades in your trading. So hello, welcome back to a new video, and thank you for the overwhelming feedback on my last video. If you want to keep supporting me, I turned off all the ads on this YouTube channel and I completely rely on your comments, your likes and your opinions. So let me know in the comments below and I will keep making more of those videos. So in this video I have prepared something really special, and I don't think you have heard about the concepts that I'm going to share anywhere else. So we're going to talk about the problems that many traders have with indicators and how to overcome them. And then in the second part, I will show you those 4 indicator systems, how to create a very robust indicator system, and what you need to know when it comes to indicators. So let's get into this. So when it comes down to why traders can't make indicators work, indicator redundancy and a wrong use of indicators is usually at the core. Indicators are great tools if you know how to use them, and I will show you exactly how to do that. However, if you use an indicator in the wrong way, then obviously it's not going to help you. It's just like if you want to build a house, you might have a hammer and you might have a screwdriver, but if you only use your hammer for everything that you are doing, obviously a hammer will only get you so far, and if it comes down to screwing in a screw, a hammer will not help you. It's not the hammer's fault, and you're not going to say, oh, the hammers suck in the world, I'm never going to use a hammer again. No, you're just using it in the wrong context. And that's the same thing that is applicable to indicators. Every indicator is built for a different purpose. So you need to know exactly when to use the indicator and how to use it, and how to use the best indicators together. When you're not doing this, then the problem is indicator redundancy. You're going to have indicators that show you the same signals, you oversize certain types of informations, you neglect other types of informations because you don't have an indicator that covers all the bases. The problem here really is that indicators are widely used without a specific purpose. You just throw an indicator on your charts and then you try to find some type of information or some type of signal. This is not how indicators are used and not how they were built or intended to be used. So this is what indicator redundancy looks like. We have a chart, you have a stochastic, a RSI and a MACD all put together, and those 3 indicators, they all show you the same information if you don't know what you're looking for. So when the market is in a strong uptrend, like it is here, the RSI, the stochastic is an overbought, the RSI is moving higher, the MACD is green and above 0 as well. If the market is in a range, you can see the stochastic is moving against the previous uptrend, the RSI is flat, and the MACD has also changed. When there is a divergence, all the 3 indicators will also show you a divergence. So this is what you call indicator redundancy. It means that all the indicators show you pretty much the exact same signal. So what happens is that in case of an uptrend, if you use maybe not all of 3, but maybe you use 2 of them together, it means that this suddenly looks like a very strong market because all the indicators are showing you the exactly same things, and you might neglect information that could highlight a potential return or a potential reversal. So if you have indicators that show you exactly the same things, it means that you are mostly not paying attention to other things and you're putting way too much importance on certain indicator signals, and then you make the wrong conclusions, and then obviously your trading results are not where they should be. Here another example, you have the ADX and you have the Bollinger Bands, and if you don't know what you're looking for, those will also tell you the same things. During a strong uptrend, the price is close to the outer Bollinger Bands, and also the ADX is moving upwards. During a downtrend, the market is close to the outer Bollinger Bands and the ADX is moving upwards. During a range market, the Bollinger Bands, they will tighten, the market will fluctuate in the middle, and the ADX is flat and below 30 as well. So again, this is a problem that many traders have, but luckily there's a solution, as we will see in the second part of this video. So when we take a look at the different indicators, I have divided them into different categories: momentum, trend indicators, volatility, chart studies. You can pause the video, take a look at the different categories and the different indicators to see where they fit in. So very classic momentum indicators are most of the time oscillators. So stochastics, we have the RSI, we have CCIs and the MACD. We have the general trend following indicators, will show you trend strength, how strong is the market moving into a certain direction, which are ADX, moving averages, MACD, they fall into both categories, and the Bollinger Bands can also be used as a trend indicator. Then we have volatility indicators, which can show you information about how strong is the market fluctuating. Those are the Bollinger Bands. ATR, to some degree, they fit into both categories. Keltner channels as well, and the envelopes. So those are a few tips and just a basic idea that you know how to classify and categorize your indicators. So what is the solution to using indicators in a better way? So we want to get away from redundancy, and we want to get away from this general approach of how most traders approach their indicators. Because indicators are really, really great tools if you know how to use them. So the first main key point is purpose-driven indicator use. This is really important. You need to define the exact use and the exact signal of each indicator and make sure that they fit together. We will take a look at this in the next slide, but what does it mean? It means that an indicator is a tool. So let's take a look at a few examples. So indicator combination 1, you could use the ADX as a trend filter. The ADX is a great tool if it comes down to differentiating between trends or range markets. I will show you this in the next chart. Bollinger Bands are great for volatility spikes, and very, very important. Every indicator has one individual purpose. So you're not going to start looking for the Bollinger Bands for anything else. You're only going to look for volatility spikes. You're not going to use the ADX for anything else but as a trend filter to differentiate between trending markets and range markets. Very important. So we have the ADX here in the bottom. And when the ADX is above 20, then you are looking at a trend. And if the market is below, and if the ADX is below 20, you are looking at a range. So you're looking for volatility spikes with the Bollinger Bands. And what is the idea of the system? The idea of the system is that you want to trade a range market, because in a range market, the market fluctuates up and down and up and down. You want to avoid trending markets at all costs, because volatility spikes don't work in trending markets. So whenever the ADX is above 20, you're not going to look at anything that moves outside of the Bollinger Bands, here and here, for example. Then once the ADX shows you, okay, now we are in a range, now you can start looking for Bollinger Band spikes, which happened here. The market jumped outside, had a nice pin bar, and fall back. The market jumped outside, fell back, and moved higher. The market jumped higher, fell back, moved a little bit. Not everything will work out 100% of the time. Here, again, next signal, the market jumped out of the Bollinger Bands, fell back, and moved lower. All the while the ADX was below 20, which confirms the range market. So you can see at this very, very simple example, every indicator has a specific purpose, and every indicator or all the indicators work together to help you form better trading opinions. Of course, you could use the Bollinger Bands in many different ways for trend riding, for whatever you may come up with. But in this example, and how you should use is that indicators define one purpose per indicator. Example number 2, we're going to use again an ADX as a trend filter, and we are going to use the Donchian channel to time breakouts. Again, every indicator has its own individual purpose. So what we're going to do is, again, a trend filter. We are only going to look at the Donchian channel for breakouts if you are in the trending market. In a range market, when the market is moving sideways, you don't want to look for breakouts, obviously. You could, for example, look for spikes like here or here, like we did in the previous example with the Bollinger Bands. But this is a trend trading strategy. We want to look at a trending market, which is confirmed when the ADX is above 20. And then you look for pushes into the highs of the Donchian channel. And you can see every time the market moves higher during a trend, not every time, but most of the time, the trend continues. So obviously, this is a very, very basic and very crude way of combining indicators, but you see how this is purpose-driven, how it fits together, how every indicator is doing what it is best, and if you use them together, you can form a very, very solid and robust trading approach. Here again, indicator combination number 3. We're going to use a long-term moving average from a higher time frame for the directional filter. So the moving average helps us to distinguish between long and short markets or bull and bear markets. And we're going to use trend lines to define pullback patterns. So you can see this is the long-term moving average. This is the 2-hour chart, and the moving average comes from the daily chart. And it's a 50-period moving average. So when the market is above this moving average, we're only going to look for long trades. If the market would be below it, then we would look for short trading opportunities into the direction of the trend. That's the tool of and the purpose of the moving average. And now we're going to use trend lines to define pullback patterns. You can see here, very nice, the trend was started, the market pulled back. We have a very well-defined wedge or channel or whatever you want to call it. And then you can see here the market broke out and moved higher. We have our second pattern here. The market consolidated. We were able to draw a very nice, well-defined pattern here with these indicators. And then the market broke out and moved higher. And again, very simple, but every indicator has its own purpose. Every indicator is doing what it's best. And then you come up with very sophisticated and robust trading approaches. Now, the last point, we are going to use again a long-term moving average for again the directional filter, and then we are going to look for an RSI divergence. So whereas in the example before we were looking for continuations into the trend direction, now we're going to use the moving average and the RSI divergence to look for a strategy that trades into the opposite direction as a reversal approach. So the market is above the moving average, so we're going to look for short opportunities with a divergence. When the market is below the moving average, we want to look for long and buying opportunities with a divergence. And you could trade them back to the moving average, for example. So here you have a very strong trend. Then here the market ran out of steam. We have a divergence, higher highs on the price, lower highs on your indicator, and then the market sold off. Then a very strong downtrend. The market dipped below this long-term moving average. Here the trend bottomed out. We have a divergence, lower highs, lower lows here, higher lows here. And then the market reversed back into the moving average. So again, it really depends on how you want to use the RSI. Obviously, you could use it in many, many different ways. But what you don't want to use the RSI and the MACD and the moving average in the same way. So you don't want to have a trend filter here and then another trend filter here at the bottom, because you're not going to get any meaningful additional information out of that. You're going to look at, okay, what is the RSI here for? It is looking for exhaustion, which it does here. And it helps us, and the long-term moving average helps us with defining the trade direction that we are going to look for, back to the moving average. And this is how you can use purpose-driven indicators in a much, much better way. So let's recap and a few other tips. Ask yourself, what is it that my system is doing? So ask yourself, okay, what type of system do I want to trade? Is it a trend system? Is it a range system? Do I look for exhaustion? Do I look for continuation? What is it that I want to do actually with my system? What is the idea behind the trades that I trade? Again, exhaustion, is it continuation? Is it a pullback? What is it? And what are the requirements then? So you can look for, okay, like we saw in the beginning, we were using the ADX as a trend and range filter. You only want to trade trends, and during trending markets, use an ADX. If you only want to trade in ranging market, use the ADX below 20. If you want to trade with the direction of the trend, then use maybe a longer term moving average from the higher time frames. Ask yourself, what are the requirements here? And then you find the right tool, you define its purpose, you put them together in a meaningful way, you avoid indicator redundancy, and then your trading will be elevated into a much, much higher level. You can obviously also use this with general price action. So look at the different tools that you have, support and resistance, trend lines, supply and demand, Fibonacci's, whatever. Then put them together, ask yourself, okay, what is the individual purpose of each of your tools? Put them together, and then you can build a very, very robust trading approach. So again, please leave a comment below the video. It really makes a big difference, and I look forward to hearing from you in the next video, which will probably come this Sunday.